Understanding an LBO model is crucial for anyone in private equity, investment banking, or corporate finance. It's more than just a spreadsheet. It's a powerful tool for evaluating potential investments. LBO modeling is a core skill. It's what private equity associates, investment bankers, and finance analysts use daily to assess the viability of highly leveraged transactions. This model helps you evaluate the feasibility of leveraged acquisitions and, most importantly, project the potential returns for investors. It's about making informed financial decisions. Welcome to our in-depth walkthrough of overviewing a leveraged buyout, or LBO, model from scratch. This video is designed to be comprehensive, detailed, and provide the overview. Every robust LBO model begins with a solid set of key assumptions. These are the building blocks that dictate the entire financial projection. It dives into entry and exit multiples, which are critical in valuation. They directly impact how much a private equity firm pays for a company and how much they sell it for. It also contains revenue growth forecasts and the intricate debt structure, including various tranches and their specific terms. Further, it covers assumptions on margins like EBITDA and EBIT, capital expenditures, and the ever-important working capital needs. It's paramount to use conservative, stress-tested assumptions. This approach makes your model defensible and provides a realistic view of potential outcomes, even in adverse scenarios. Model elaborate on entry and exit multiples as they are central to the LBO valuation. It contains detail how revenue growth projections influence future cash flows and how a robust debt structure impacts the capital stack and financial risk. Next, we move to the sources and uses of funds, a fundamental table that traces exactly where the cash comes from and where it's allocated in the transaction. This section breaks down the entire financing structure, distinguishing between equity contributions and the various debt tranches involved. It paints a clear picture of the capital structure. Sources typically include sponsor equity, different debt tranches like senior debt and mezzanine, and sometimes rollover equity from existing management. The uses of funds cover the purchase price of the target company, transaction fees, and the refinancing of any existing debt. Crucially, the sources and uses table must always balance perfectly. This is your first major check for model accuracy. Now let's integrate the financial statements, the backbone of any robust financial model. It includes the income statement, balance sheet, and cash flow statement. This interconnectedness is vital for comprehensive financial forecasting. EBITDA serves as the primary driver of operating cash flow, making its accurate projection paramount. We'll also model depreciation, capital expenditures, and changes in net working capital, all of which impact cash flow. The importance of consistency and rigorous error checking cannot be overstated. Every link must be logical and auditable to ensure model integrity. Next, we tackle the debt schedule, a critical component that details the company's financial obligations. This section calculates annual principal and interest payments for each debt facility, outlining the cash outflows related to financing. It'll differentiate between various debt tranches, such as senior debt, mezzanine debt, and subordinated debt, each with unique characteristics and payment priorities. Once the financial projections are in place, the ultimate goal is to calculate the key return metrics for the private equity deal. The model contains the calculations of the internal rate of return, or IRR, which measures the annual rate of return on the investment. It'll also calculate the multiple on money, or MOIM, indicating how many times the initial investment is returned. The calculation involves linking exit assumptions, such as the exit multiple, with the projected equity value at the time of sale. It's important to demonstrate how returns are sensitive to the exit year timing and changes in valuation multiples. Sensitivity analysis is essential for understanding the robustness of your LBO model under different scenarios. LBO model explore key sensitivities such as revenue growth, margin expansion, the exit multiple, and the initial leverage used. Building two-way data tables allows you to test multiple drivers simultaneously, providing a comprehensive view of how changes affect returns. The importance of including downside and stress case scenarios cannot be overemphasized. This demonstrates the model's robustness in adverse market conditions. Even the best models can have pitfalls. Let's discuss common mistakes and how to avoid them. Implementing robust audit checks and error flags is crucial for identifying and correcting mistakes quickly. Best practices include color-coding inputs, using clear formulas and strictly avoiding hard coding to maintain transparency and ease of use. The goal is to create a model that is not only robust and accurate, but also easy to understand and present to stakeholders. Avoid overly aggressive assumptions, which can undermine the model's credibility, and steer clear of messy formatting that hinders readability. Focus on building clean, professional, and defensible models that stand up to scrutiny and support sound investment decisions. Artificial intelligence is rapidly transforming financial modeling, including LBOs. AI tools are automating data gathering and enhancing model validation, significantly speeding up the process. Natural language processing, or NLP, is being used to analyze confidential information memoranda and other financial reports. AI helps benchmark assumptions against vast industry databases, ensuring your model is grounded in real-world data. In the future, expect AI-powered scenario generation to enable faster and more precise investment decisions. Thank you for joining this in-depth LBO model walkthrough. Remember, this content is for educational purposes only and not financial advice. Always consult with a qualified financial professional before making investment decisions. If you found this video helpful, please like, share, and subscribe for more detailed financial modeling tutorials.